Hey folks, I'm talking today on Fatca versus the Common Reporting Standard. The Common Reporting Standard is which is called CRS, is an information standard for the automatic exchange of information regarding bank accounts on a global level between tax authorities, which the Organization for Economic Cooperation and Development, which is called the OECD, developed in 2014. Its purpose is to combat tax evasion. The idea was based on the U.S. Foreign Account Tax Compliance Act, which is FATCA. 97 countries had signed an agreement to implement it, with more countries intended to sign later. First reporting occurred in 2017, with many of the rest starting in 2018 until 2014. The parties to most treaties for sharing assets, incomes, and tax information internationally had shared it upon request, which was not effective in preventing tax evasion. The new system was intended to transfer all relevant information automatically and systematically. The agreement has informally been referred to as GATCA, G-A-T-C-A, the global version of FATCA, but CRS is not just an extension of FATCA. They're almost the same ball of wax. But one is really dealing with U.S. persons. The other one is dealing with mostly from European countries, but that's extending throughout the whole world. Right now, there's the countries that are non-participating countries. There's about 59 that aren't, actually involved with the CRS as of right now. But that's accumulating. There's more and more countries that are actually getting on that list. Eventually, you're probably going to have close to the whole world on the list. In 2010, U.S. Congress enacted FATCA, which is the Foreign Account Tax Compliance Act, in an effort to stem the tide of U.S. persons using overseas accounts and assets for the purposes of tax evasion. FATCA works like this. First, individual taxpayers must report their qualifying foreign income to the Internal Revenue Service, the IRS. At the same time, the foreign financial institutions, which is called FFI for short, that hold or process that income must report the identity of their qualifying U.S. clients to the United States. Despite whatever headaches it may cause for corporate accountants and compliance officers, it is a regulation that has met with a measure of success. That might be one reason why 9 years later, the Organization for Economic Cooperation and Development, the OECD, at the request of the G20 and the G8, proposed similar regulations under the name CRS, or Common Standard on Reporting and Due Diligence for Financial Account Information. Okay, let me go over the differences between FATCA and the CRS. One of the biggest differences between FATCA and the CRS is the breadth of its design. FATCA requires financial institutions to report only those customers who qualify as U.S. persons. CRS involves more than 90 countries. Under CRS, virtually all foreign investments handled by a financial institution become subject to a CRS report. Due in part to CRS's wider scope, the nature of the relationships between financial institutions, country, and regulatory authority has also changed. Under FATCA, each country entered into a separate bilateral intergovernmental agreement with the United States. Part of FATCA's power lies in its resolve to collect information from RFIs concerning the financial dealings of U.S. taxpayers. Initially, this relationship was entirely one-sided. Thus, it was truly a collection, not an exchange. In subsequent years, at the insistence of the G20, FATCA has modified its position on data reciprocity, but it's still not an equal exchange. To note, under FATCA stipulations, the IRS is still not obligated to share information pertaining to cash accounts held by entities, including those that are resident in FATCA partner jurisdictions, non-cash accounts, whether held by individuals or entities, unless the accounts earn U.S. source income, and controlling persons of any entities that have accounts in U.S. financial institutions, regardless of whether those entities are from the partnering country, even if those entities are owned and controlled by residents of the partner jurisdiction. While the move toward equal transparency is considered progress, the exceptions that I've just mentioned still place the IRS at a considerable advantage. The CRS, by comparison, requires a full reciprocal exchange of financial data from each partner who enters into the agreement. This has led to a much higher rate of participation. The number of multinational CRS agreements exceeds 1,450, far outpacing these institutions engaged in Fatca partnerships. One of the ways that the IRS encourages compliance with its Fatca regulations is by imposing sizable penalties over those companies who fail to report their U.S. taxpayers list. Companies who register with the IRS agree to withhold 30% on certain U.S. payments to foreign payees if those payees do not provide verification of their taxpayer status. This puts the work of the client identification and verification on the RFI and not the IRS. By contrast, the CRS does not charge a withholding tax to any of the RFIs working under its provisions. There are problems with exemptions. For example, Fatca supplies a mechanism for taxing income earned or stored in offshore accounts, but it does not apply its rules equally across all entities. Instead, it has carved out a number of exemptions for certain business types, which in effect exempts all U.S. taxpayers from foreign accounts that have exceeded $50,000 US. So, for example, a charity is not required to file Fatca reports, nor are companies that are part of a publicly traded exchange. CRS offers no such exemptions for charities, RFIs, or publicly traded companies. The only exemption it allows is for pre-existing accounts prior to 2015 of a value up to $250,000 US. That means, in effect, virtually all other financial accounts held by individuals in every reportable jurisdiction are required to file with the CRS. Folks, if you want to learn more about how to get your taxes to zero, close to zero, or you're looking for a second passport as quick as 4 months, visit our website, www.citizenshipquickly.com, and hit the subscribe button to the right of your video, and you'll get new videos as they come out automatically. And also, if you go to our website, you'll pick up, we deal with about 67 different citizenship by investment or residency by investment countries that I think you'd be interested in looking into. And I look forward to talking to you on our next video. Take care.